Hello. Hey, thanks for stopping by. Thanks for giving me a little bit of your time. I appreciate it. Today I'm going to talk about a recent Bloomberg Markets Daily newsletter. And I think this was it was definitely from Monday. And in their newsletter, they had a section in the newsletter, and it was called The Surging Price of Money. Now what this section went through, it was a lengthy section, is really they're substantiating the new normal on interest rates. And so what they said, what they would explain, I'm going to go through this in a little bit more detail because not everybody has access to Bloomberg. It's a pay subscription. But so what they went on to say is that the U.S. bond market's in the sixth year of what is being called the third great bear market since 1790. And so we're in this giant bond bear market where U.S. Treasuries, the 10-year Treasuries now at nearly 5%. And it's looking like it's going to stay there. And we're not the only country with elevated longer-term interest rates. The UK, the gilts are, of course, going to hit hard. Their yield is just skyrocketing. And the Fed is challenged because the Fed has cut short-term interest rates by 100 basis points. And in that same time, long-term interest rates increased by the same amount. And so the Fed, which has always been true, doesn't control the long side of the curve or doesn't control longer maturing bonds. It can only control short bonds. And so the market isn't buying what the Fed is selling it. It's not buying that there should be smaller yields. It's demanding more. Now, why? Well, inflation remains sticky. And then the fear that inflation may grow under the new administration, who has said that they're going to do lower taxes and have higher tariffs, and they're going to deport people. All those would be inflationary. Now, there may be things that offset that, but on their face, those are inflationary. And then at the same time, and these yields, they're not just harming these higher rates, long-term rates aren't just harming the real estate and mortgage markets, but it's really having a ripple effect across the globe because other countries who deal in U.S.-based currencies are having a really hard time dealing with these higher yields. Not to mention, the U.S. government's going to have a hard time having higher rates on their outstanding debt, which is certainly a problem. Now, what does this all mean for you and I? What does it mean for mortgage and real estate professionals? You want to know? Not much. The prediction is, so the forecast is we're going to do $2.3 trillion this year. I don't think we will, probably be closer to 2.0, 2.1. But those are good years. And given the amount of attrition we've had, we have far fewer participants. So there's going to be more business for everyone. Analysts are forecasting we're going to do about 30% of our volume is going to be refi. Pretty solid. 700 million, 700 billion, 750 billion. We're probably going to have an okay year. And consumers are getting used to that interest rates in the 6s and 7s. And there's all this pent-up demand is starting to bubble up, and so we're going to see cash out, refinances, debt consolidation, all those, life event types based refis. We're going to see purchases heat up a little bit, get stronger this year. So we don't have to get that emotional about these higher interest rates. I would just say, the interest rates have normalized, and the 5% rate, the treasuries have normalized to where they've normally been. Now I'll quickly show you which, like I said, you may or may not be able to see. This is the price of money. This what I'm referring to is from Monday's Bloomberg Daily Markets newsletter. In it, one of the things they show is how the Fed has cut the short-term interest rates. The 10-year bond has just gone up almost in equal amounts. It's a good read. You can see now that our bond yields returned to pre-financial crisis levels. So if we go back to pre-2008, so 2007, we're about where we were before. We just got used to these ultra-low rates just due to the financial crisis and really the Fed participating was a major buyer of bonds until March of 2022. So not something to be aware of. And the way we need to be aware of it, and I'll tell you, as you know, if you follow me, I did a article. I posted an article to LinkedIn. I'll give you my things. I posted an article to LinkedIn last year saying, hey, rates may be as good as they're going to be for the foreseeable future. And my whole challenge was, if you think that we are at the lowest that rates are going to be for the next 10 years, how would your advice to your customers change? And it's possible we are. It's possible this is our rates. And so how does your advice change versus selling them, hey, rates aren't going to improve anytime, and doing short-term strategies with them? I think it's okay to say the economy's booming. I think it's okay to say things are great. Now's a great time to buy. We're at normal interest rates. It's just a factor of life. It's okay. Anyway, that's my point of view. I wanted to share this Bloomberg article. Check me out on LinkedIn. I did do a lengthy post on this newsletter this morning in my LinkedIn. And what's important about that, you may or may not be able to access this Bloomberg newsletter. I will put a link to it in my notes below, and I do have a link to it in my summary of this newsletter on LinkedIn. But if you can't get to the newsletter, check out my LinkedIn. With that, I really appreciate you spending some time here. We're off to another good week. It's going to be a great year. I look forward to talking again soon. Thanks.